So, good day, guys. Today we'll be talking about market structure. So, I want you to understand that in the first chart, there's something we call market structure, and that market structure is the directional movement of the market. Remember, I said this market is a graph. The diagram of this is a graph, the chart. It's a chart that is displaying the directional movement of this commodity, which is gold. I'm using this as an example. This chart is displaying the price action of gold over time. You can see the price action of gold over time has been going up, coming down, coming down, coming down. This is what gold has been doing over time. So this movement on the chart is called market structure. The movement of this price action of gold is called market structure. Likewise, every other currency pair, they are like this too, they move like this too. So on this example, we are using gold. So the movement of this chart, like this, up and down, is called market structure. So let's go back to the drawing. We have three types of market structure: the bullish market structure, the bearish market structure, and the consolidating market structure. The bullish market structure is a market structure that consolidating. Yes, you can put it like that. So the bullish market structure is a market structure that is a buying pressure market structure. A market structure that is buying. Understand? A market structure that is buying. That's a bullish market structure. Let's say, for instance, let me take you to my history. Hold on. No. So you can see my course outline. These are my course outline I'm giving my students whenever we want to trade. These are the course outlines I teach my students. So I've done the first video for trading view, did the second video for forex, and I'm on the third one for teaching you guys for free. So you just have to do me a favor, subscribe and like the videos I drop, because I'm still going to be dropping more about time frame, forex trading sections that are convertible into Nigerian time, fundamental analysis, order block, breaker block, fair value gap, all you need to know about order block, fair value gap, all these, risk management and lot size, pips calculation, SMC, supply and demand, premium and discount, pending order, support and resistance, ranging market, and so on and so forth. So these are what I teach my students. Those that pay for mentorship fee, I guide them like this to teach them gradually what they need to learn, holding them by the hands. I have a lot of students that have sent testimonies to me, but I don't want to start posting testimonies. But I have a lot of students that have been profitable too. Excuse me. I have a lot of students that are profitable as well. So I'll just go into the business of the day to teach you what market structure is. Market structure is the directional movement of the chart, either for the buy side or for the sell side. You can see, let me show you what it says here. It says market structure refers to the organizational characteristics of a market primarily determined by the price action and the arrangement of higher highs, higher lows, lower highs, and lower lows in a financial market. It describes how price move over time, forming patterns that indicate the market trend or direction. In technical analysis, market structure is often analyzed using charts to identify trend, support and resistance level, and potential reversals. It reflects the balance of supply and demand driven by the behavior of buyers and sellers. So, driven by the behavior of buyers and sellers. So, they have three types of market structure, which is the bullish market structure, the bearish market structure, and the consolidating market structure. The bullish market structure, the bearish market structure, and the consolidating market structure. So, these are diagram example of what the market structure is. This is a bullish market structure. Higher high, higher low, higher high, higher low, higher high, higher low, higher high. The market is moving upward. While the bearish market structure is lower low, lower low, lower low. Market is moving downwards. These are opportunities for you to buy and sell. In a bullish market structure, it's an opportunity for you to buy. You see, it can also be called an uptrend. In the bearish market structure, it can also be called a downtrend. It's an opportunity for you to sell. And this is a consolidating market structure, a ranging market structure that is not giving you any direction. So look at what it says in the bullish market structure. A bullish market structure occurs in an uptrend where prices are increasing over time, reflecting stronger buying pressure than selling pressure. It is characterized by higher highs, each successive price peak high is higher than the previous one. Higher lows, each successive price true low is lower than the previous one. This pattern indicates that buyers are in control. In a bullish market structure, it indicates that buyers are in control, pushing price over time, pushing price upward, and sellers are unable to drive price significantly low. Example, if in a stock chart, if the price moves from $100 to 120, let's say for instance, the price of tomato is 100 naira, all of a sudden it increased to 120, then you went back to the market again and say, oh, the last price we can sell for you is 110, you bought at 110. The next day you went again, they say, we are no longer selling at 110, oh, we are selling at 130. You can see the market is going up. It will just drop down a bit, but it will not drop down to the initial price. Just like fuel, when you want to buy fuel now, you see fuel will go up. When it has gone up, if the government has done their job, it will come down small, but it will not go back to the initial price where it was before it skyrocketed. So it will just drop down small. Then after it has been bought at that price, you see it going up again. That is an example of a bullish market structure. The price of fuel is going up. It's bullish. The price of fuel is going up. That's what it means. On the chart, on the diagram, that's what it means. Do not forget, this chart, this diagram is simplifying, is showcasing every price movement of the chart. This diagram is showcasing every price movement of a commodity. That's what this diagram is doing. Showcasing every price movement of a commodity. This is for gold. You can see, you see that of silver, see silver, see Bitcoin. All of them are showcasing the price movement of the commodity. Do not forget, this side is the price level, the digits, and this side is the date. So you can see this is the price level. Currently, gold is at 4,121 and is intending to sell downwards. So the market structure is all about a bullish market structure that is going upward and a bearish market structure that is coming downwards. Then the consolidating market structure is a ranging market that is not giving us any direction. So this is a diagram of a bullish market structure. I've explained that market is going up, giving us higher highs, higher low, higher highs, higher lows. It is creating new highs. You see this previous high, see the new high, created a new high above this. You see this new high, created a new high above this previous high. This new high created a new high above this previous high. That's a bullish market structure. And you can see a bearish market structure occurs in a downtrend where prices are decreasing over time, reflecting selling pressure and buying pressure. It is characterized by lower highs, each successive price high is lower than the previous one. Lower lows, each successive price low is lower than the previous one. This pattern indicates that sellers are in control, driving price downwards, and buyers are unable to push price significantly low. Example, in a stock chart, if the price drop from $100 to 80 first low, rallies to 90 first high, falls to 70 lower low, and rallies to 85 lower high. This reflects a bearish structure, that is, the market is falling. Implications are traders often look for selling or short opportunities in a bearish market, expecting price to continue falling, breakout below support level, or rallies to resistance level are common entry points. You see the example, a diagram example of the bearish market structure is giving you high, lower low, lower high, lower low, lower high, lower low. It's breaking new positions downwards. In notes, market structure is often identified using price charts, candlesticks, and tools like trending lines, moving average, or indicators like the relative strength index RSI to confirm the trend. Yeah, this one is gonna be later, maybe when you join the inner circle. The transition market structure can shift. For example, bullish market structure may break if a lower low or lower high forms, signaling a potential trend reversal. This is called a change of character. When the market structure changes from a bullish market structure to a bearish market structure, it's called a change of character. And when the market structure changes from a bearish market structure to a bullish market structure, it's called a change of character. Simply, a bearish structure may reverse with higher highs and higher lows. Context: both bullish and bearish structure can occur within large trends. For instance, a pullback. Temporary bearish structure can occur within a broader bearish structure. Sideways market. When sideways market, like I told you, sideways market is a consolidating market. You don't intend to take positions in a consolidating market because it is not giving you any direction. You don't know what to do when you see a consolidating market. So, understanding market structure helps traders make informed decisions about trade entry and exit points, risk management, and trend following strategies. If you like, I can. So, this is a diagram example of a bullish market structure and a bearish market structure. You can see at this point here, this is a new high, new low, higher high. This previous low is not below the original low. It is still above. This low is still below this low. That's why it's still bullish. If that this one has broken downwards, creating a lower low below this low, it's now called a change of character. It's no longer bullish, it's now reversing to be bearish. So you can see this one is still respecting this low, that's why it's still bullish. And this one is a new high created above the previous high. So it's going upward, it's still going upward. And likewise this one too. This one is respecting this previous high, it has not created a new high above it, creating new positions downward. That's why it's still bearish. So you can see the diagram I drew here. This diagram is identifying that the market is going up. You see, it's going up. These are the lows. These are the lows for the bullish example. These are the lows. So don't mind my drawing. These are the lows. You can see the bullish example and the bearish examples. These are the highs. All these points I'm mapping out are the places that causes the market movement to keep going downwards. That the ones that causes the market movement to keep going downwards, and the one that causes the market movement to keep going up. So you can see these are the highs. They're creating new positions at this point here. They're creating new positions here, creating new highs at this point. All these things are given a name as well. But I'll see that in our next class. You can see the new positions that are creating new highs above the previous high. That's why it's called a bullish. Why this one is creating new lows below the previous low. That's why it's called bearish. This one is creating new lows below the previous low. That's why it's called bearish. It is on this chart position, the bearish market structure, that you'll be looking for a bearish opportunity. Do you hear me? On the bearish market structure, you'll be looking for bearish opportunity. On the bullish market structure, you'll be looking for bullish opportunity as well. So that's it. And this an order block. This is an order block as well. So on our next class, I'll be teaching you guys what an order block breakup structure is and fair value gap. So on this consolidating example, you can see this one is not giving us any market movement. It's just ranging. We are having equal highs and equal lows. All these things are equal highs and equal lows on the consolidating market structure. We have equal highs and equal lows. Equal highs, equal highs and equal lows on the consolidating market structure. So there is no need for taking your trade on a consolidating market structure because it's not giving you any direction. But on a bullish market structure, we look for buying opportunities, and on a selling market structure, we look for selling opportunities. So guys, I'll see you guys in the next class as we move on to the next.